let me take us and talk about some stories, because that's what I really like to talk about. And I've had to limit it this evening, and I've picked Alberta because Alberta's a great place to invest. For starters, when you purchase an asset, you don't have to pay property purchase tax. All of you in BC know how expensive property purchase tax is. Well, if you can buy an asset without property purchase tax, that's a lower starting point. You also have an economy where there's no sales tax. And so you've got high disposable income. Retailers love Alberta because you've got high disposable income. And I don't know, the winters always seem long when I'm in Alberta, so there's lots of time to shop. What did we buy in Alberta? We bought this shopping center. It was actually one of our original investments. We bought it in 2006. We acquired it for $25.3 million. Going back to 2006, at the time, this particular asset represented 43% of our total portfolio. So we didn't have the diversification that a $25 million asset has in our portfolio today. And we've learned the importance of diversification. What we liked about this particular asset, it had national retail tenants. So good solid tenants, that's going to help with our cash flow and our income. It was 99% leased. Keeping our buildings full is really a high value and a major function of our asset management teams. It had a strong trade area. Northwest Edmonton along 137th was a strong retail node. And there was a value add opportunity in the property behind, which we weren't quite sure. It wasn't rezoned, but it had potential. So there was a value add opportunity. What's happened to that asset since 2006? Well, Eric's talked about the downturn in the market in 2009. Well, that impacted the retail trade even in Alberta. One of our tenants, and throughout our portfolio, we had two pet stores. One of them, Pet Cetera, went bankrupt in 2009. That was a major tenant in our portfolio. We've since replaced it with Le Chateau. In fact, over that 9 years, we've replaced 12 of our tenants. Well, what does it cost to replace tenants? It cost us over $900,000 to replace those tenants over the last 9 years. So that's something that reduces your income. We also had to spend money because we really want to look after our assets. We look after them for the long term. So we've spent $2.2 million on capital upgrades. One particular story, I got a call several years ago, and they said, Wayman, there's a sinkhole in our parking lot. And sure enough, they sent the photos, and there was a great big hole that had appeared in the parking lot. Those sort of things are kind of hard to budget and manage. We do annual business plans for each of our assets. We look at how much capital we need to spend to look after the asset. We look at the tenants and say, how can we renew those tenants? Is there any repositioning that we need to do? So we're constantly looking at both the tenant mix, the tenants, the lease maturities, the debt, the capital. So in this particular asset, we can see where we had underwritten $900,000 of what we call CapEx, but over the last 9 years, we spent $2.2 million. So those are the outflows. What happened on the inflows? Well, we exceeded our underwriting from 2007 to 2009. Eric's talked about the good years in the early days. But what's interesting is that we managed to grow the net operating income over the last 9 years by 2.4%, so greater than the rate of inflation. So what has that done to our rate of return? Well, we've managed to achieve just under 11% IRR over that 9-year period. One of the things that we're always doing is we're looking into the future, and we're saying, okay, we bought this asset back in 2006. We've had its ups and downs. What are the risks versus the opportunities? And as we look forward down the road, we say, okay, along 137th, over the last 9 years, there's been a lot of retail development. There's been some new centers that have gone in. We've had to replace some of our tenants. We've noticed that the tenants that we've been attracting wanted to be on percentage rents. They weren't necessarily at a level that we felt if there was a bunch more renewals coming down the road, there might be some additional risk. One of the things that we really want to do is keep our centers full, so we're looking and weighing the risks of lease rollover, which even though we may be under market rents, may be a risk, it may be an opportunity. We look at what's happening in the neighborhood, we look at what's happening with our tenants, we look at the CapEx, and the main question that we end up asking, and we've got an investment review committee that has 8 people that are a lot smarter than I am. We have an asset management team, we have a finance team, and we actually benchmark all of our assets with a group called IPD. We look at all of this data and we say, is this an asset that we would buy today? We're constantly asking that question. Is this asset fully valued? Is there more opportunity for this asset in the future? In this particular case, we've owned it for 9 years, but we've said, and the decision was made back in the spring, we think it's time to sell this asset. So we put it on the market, used a great marketing team. We received a few bids. We went through a process, and all the subject conditions have been removed, and that will close in the next couple weeks. So when I'm talking about just about an 11% IRR, that's after all fees, and that's over that 9-year period.